You think you're in the 40% tax bracket, but if your total income crosses £100,000 this year, you're actually paying 60% on every extra pound, and most people have no idea. Not 40%, not 45%, 60%. And the thing is, it doesn't take a six-figure salary to trigger it. A one-off redundancy payout, an inheritance, selling a buy-to-let. Any of those can push you over the threshold for that single year, and suddenly the tax bill looks nothing like what you expected. I used to think this only caught people in high-powered city jobs. Then a client of mine sold a small rental property. Nothing extravagant, just a flat he'd held for a few years, and he ended up with a £5,500 tax bill he never saw coming. He'd done nothing wrong. He just didn't know the rule existed. That's what this video is about. There are 6 tax traps that catch UK retirees and people approaching retirement every single year. Some are obvious in hindsight, some are genuinely surprising, and all of them are avoidable with a bit of forward planning. You don't need to be earning £100,000 a year for any of these to affect you. A pension withdrawal at the wrong time, a state pension that arrives without warning, a single flexible drawdown. Each one can quietly cost you thousands. So let's start with trap 1. It's the one that catches more people than any other. The personal allowance for 2026-27 is £12,570. That's the amount of income you can earn each year before paying any income tax at all. Most people know this. What fewer people know is what happens to that allowance once your income passes £100,000. For every £2 of income above £100,000, you lose £1 of your personal allowance. So by the time your income reaches £125,140, your allowance has been reduced to zero. And the effect of that, an effective marginal tax rate of 60% on every pound in that band, because you're paying 40% income tax, plus you're losing 20p of allowance for every pound earned. 2 taxes running at once. Let's put a number on it. Say your income for the year is £110,000. That's £10,000 inside the taper zone. You'll pay 40% tax on that £10,000, which is £4,000. But you've also lost £5,000 of your personal allowance. That lost allowance then gets taxed at 20%, which is another £1,000. Actually, since your allowance falls by £5,000, but that entire £5,000 was previously tax-free at the basic rate, the combined effect means you're paying £6,000 in tax on that £10,000. That's 60%. Now, if you're earning £110,000 every year, you've probably already heard this. But what if you're earning £70,000 and you receive a redundancy payment of £50,000? Suddenly, your income for that year hits £120,000. You didn't plan for it. You didn't see it coming. And yet you're sitting in the 60% zone for a significant portion of that payment. I've been caught out by the emergency tax code on a pension withdrawal myself. It took me 3 months to get the overpayment refunded. That experience taught me how the system can work against you the moment you're not paying attention. So what's the fix? It's called income smoothing, and it's simpler than it sounds. If you know you're going to receive a large one-off payment, a redundancy, a property sale, an inheritance, the goal is to spread that income across 2 tax years rather than taking it all in one. If your redundancy lands in March, and some of it can be deferred until after the 5th of April, you may stay below £100,000 in both years and avoid the taper entirely. If you're selling a property, use your capital gains allowance, and consider whether the timing of completion can straddle 2 tax years. The fragility path is straightforward. Take everything in 1 year, cross £100,000, pay 60% on the excess. The resilience path takes a bit more planning. Spread the income, stay below the threshold in each year, pay 40% or less, and keep the difference. If you're approaching retirement and want to stay ahead of traps like this one, hit subscribe. I cover the exact strategies to protect your income every week. But the 60% trap is just the beginning. The next one catches almost every retiree the moment their state pension starts, and it's one nobody warns you about. Most people expect the state pension to feel like a bonus, money arriving each week that doesn't come with a complicated tax calculation attached. But there's a detail that catches a lot of retirees completely off guard. The full new state pension for 2026-27 is approximately £12,548 per year. Your personal allowance, the amount of income you can receive before paying any tax, is £12,570. That means if you're receiving the full state pension, you've used up almost all of your personal allowance. There's only £22 of headroom left. Now add any private pension income on top. Say you start drawing £10,000 per year from your workplace pension. Your total income is £22,548. Almost all of that £10,000 drawdown, everything above that £22 headroom, gets taxed at 20%. So you're paying roughly £1,995 in income tax on what you thought was extra money you'd earned and saved. People expect this. What they don't expect is the timing. The state pension arrives without any tax deducted at source. HMRC adjusts your tax code on your private pension to collect what's owed. So you might find that your private pension provider is taking a bigger chunk than you expected, not because anything has gone wrong, but because the state pension has eaten through your allowance first. Is there anything you can do about it? Possibly, and it depends on your situation. If you haven't yet reached state pension age and you have private pension savings you can access, there's a window. Before your state pension starts, your personal allowance is fully available. You can take income from your private pension in those earlier years at a lower effective tax rate, while your state pension entitlement is still building. Some people refer to this as a gap year strategy. Delaying your state pension is another option. Every 9 weeks you delay past state pension age, your entitlement increases by roughly 1%, which works out at about 5.8% per year. If you have other income to live on, deferring for even a year or two can increase your weekly payment meaningfully, and you'll reclaim the personal allowance space in the meantime. Neither of these is the right answer for everyone, but knowing the trap exists is the first step to working around it. And if you think that's an unwelcome surprise, the next trap is one that catches people at the very first moment they reach into their pension. The taxman might take a third of your withdrawal before you even see the money. This one trips people up not because of a complicated rule, but because of a timing problem. When you make your first flexible withdrawal from a defined contribution pension, whether that's a one-off lump sum or the start of drawdown, your pension provider often doesn't have your current tax code on file. So HMRC issues what's called an emergency tax code. The most common ones are 0T and BR, and those codes do something that feels entirely unreasonable when you first see it on your statement. They tax your withdrawal as though that amount is your monthly income. So if you take £20,000 in one go, the provider calculates tax as if you earn £20,000 every month, which would make your annual income £240,000. You could end up with over £5,000 deducted from a £20,000 withdrawal before you've even had a chance to plan for it. The money isn't gone permanently, but getting it back isn't instant either. If you've made a one-off withdrawal and you're not planning to take any more from that pension in the same tax year, you can reclaim the overpayment using Form P55 through your HMRC online account. If you do plan to take more withdrawals in the same year, the form to use is P53Z. HMRC will typically process the refund within a few weeks, but those weeks pass slowly when it's your own money sitting in a holding pattern. There are 3 practical steps worth knowing before you ever make that first withdrawal. First, contact your pension provider in advance and ask them to obtain your correct tax code from HMRC before the withdrawal is processed. Some providers will do this if you ask. Others won't, but it's worth trying. Second, if you're making a large one-off withdrawal and an emergency code gets applied anyway, submit the reclaim form as quickly as possible. The sooner it's in, the sooner you get your money. Third, consider whether smaller, regular withdrawals over multiple months would work better for your situation. Regular payments tend to trigger a correct tax code more quickly because the provider recalculates after the first payment and HMRC can reconcile. None of this is your fault. It's a structural quirk of how the system processes first-time pension access, but being unprepared for it can tie up thousands of pounds for months. Now, taking your 25% tax-free cash sounds like a clear win, and it often is, but the way you take it can quietly cost you more than you'd expect. Everyone knows about the 25% tax-free cash. It's one of the most well-known benefits of saving into a pension. When you come to access your pot, a quarter of it can come out completely free of income tax. The question isn't whether to take it, the question is how. And this is where a lot of people make a costly mistake. Say you have a pension pot of £400,000. Your 25% tax-free entitlement is £100,000. If you take all of that in a single tax year, and you also have other income of £30,000, perhaps from a part-time job, a rental, or other savings income, your total income for that year would be £130,000. That puts you well inside the personal allowance taper zone we discussed earlier. The 60% effective rate kicks in on the income between £100,000 and £125,140, and on the income above that, you're paying the 45% additional rate. What was described to you as a tax-free lump sum ends up indirectly pushing other income into a much higher bracket, but there's a broader issue even without the taper problem. Once that £100,000 leaves your pension, it leaves the tax-free growth environment too. Any returns it earns from that point, whether in a savings account, a general investment account, or elsewhere, become taxable. Inside the pension, that same money could have continued growing without generating any annual tax liability. The alternative worth knowing about is UFPLS, Uncrystallized Funds Pension Lump Sum. It sounds technical, but the principle is simple. Instead of ring-fencing all your tax-free cash and taking it as one event, each individual withdrawal you make is treated as 25% tax-free and 75% taxable. So you're spreading your tax-free entitlement gradually, only taking it as you actually need the money, while the rest of the pot continues working inside the pension. Over a decade of phased withdrawals, this approach can save well over £5,000 compared to taking everything up front, and that's without accounting for the ongoing tax-free growth you've preserved. The fragility path. Take the full lump sum in year one, cross the income taper threshold, and lose money you could have kept. The resilience path. Take only what you need each year, keep the rest growing, and stretch the tax advantages across retirement. But even if you're managing your pension withdrawals carefully, there's a quieter tax drain that runs in the background, one that doesn't send you a bill, it just slowly erodes your returns year after year. This one doesn't arrive as a shock, it arrives as a slow, steady reduction. A percentage point here, a few £100 there, year after year. A general investment account, or GIA, is simply an investment account that sits outside an ISA or pension. There's nothing wrong with having one, but the tax treatment is very different from those wrappers. Dividends and capital gains in a GIA are subject to annual tax, and the allowances that used to soften that impact have been reduced significantly in recent years. For 2026-27, the dividend allowance is £500. That means if the investments in your GIA pay out more than £500 in dividends during the year, everything above that is taxable. If you're a basic rate taxpayer, dividends above the allowance are taxed at 10.75%. If you're a higher rate taxpayer, that rises to 35.75%. So a GIA holding a reasonably sized portfolio of income-generating funds can trigger a meaningful tax bill each year, just from the natural income it produces. The capital gains allowance for 2026-27 is £3,000. Sell any investment that's grown in value, and gains above that threshold are taxed at 18% if you're a basic rate taxpayer, or 24% if you're a higher rate taxpayer for shares and investment funds. Now, these numbers might not seem dramatic in isolation, but add up the tax on dividends and gains year after year across a decade or more of retirement, and the cumulative drag on your portfolio can run into tens of thousands of pounds. Some research suggests GIA tax drag can reduce overall portfolio returns by 1 to 2 percentage points per year compared to the same investments held inside an ISA or pension. The primary tool here is the annual ISA allowance, £20,000 per person for 2026-27. You can't move existing GIA investments directly into an ISA, but you can sell them in the GIA and reinvest the proceeds in the ISA in the same step. This is sometimes called a bed and ISA. The sale triggers any capital gain above the £3,000 allowance, but once the money is inside the ISA, all future growth and income is tax-free. Done each April. This process gradually shifts your portfolio from a taxable environment into a protected one. If your spouse or civil partner has unused ISA allowance or a lower tax rate, transferring assets between you before taking income or gains can make the annual allowances stretch further. None of this requires dramatic action. It's a slow process, like the tax drag itself, but running it in reverse, in your favor. The final trap is one that catches people who try to do the right thing and stay flexible with their pension, and it can quietly lock you out of future contributions. This final trap catches people who are doing exactly what they're supposed to do, staying flexible with their pension, taking money when they need it. The problem is a rule that most people have never heard of until it applies to them. The standard annual allowance for pension contributions in 2026-27 is £60,000. That's the maximum amount that can go into your pension in a single tax year and still receive tax relief. It's a generous limit, and for most working-age people it's not something they ever come close to. But the moment you take any taxable income from a flexible defined contribution pension, a drawdown payment, a UFPLS withdrawal, anything flexible, a different allowance kicks in. It's called the Money Purchase Annual Allowance, or MPAA, and it reduces the amount you can contribute to a defined contribution pension from £60,000 to just £10,000 per year. Once triggered, the MPAA cannot be undone. It stays with you. So why does this matter? Because a lot of people in their late 50s or early 60s dip into their pension for a one-off reason. A home renovation, a holiday they've been putting off, helping a child with a house deposit. It feels reasonable. You've saved the money, retirement is in view, and the need is real. But if you later return to work, part-time consulting, a second career, anything, and you want to rebuild your pension pot, you're now limited to £10,000 a year rather than £60,000. That's a significant constraint, and one that quietly compounds over time. The psychology here is straightforward. When we make a decision about money, we tend to focus on the immediate need and discount the future cost. A £20,000 withdrawal feels like a £20,000 decision. It isn't. It's also a decision to cap your future contribution capacity at £10,000 a year. There is a way around this if you're planning carefully. Taking your tax-free cash, the pension commencement lump sum, does not trigger the MPAA, only taking taxable flexible income does. So if you need to access your pension, but you're not certain you're done contributing, consider whether your tax-free cash alone covers the need, and avoid the flexible income route until you're confident you won't want to contribute again. So those are the 6 traps. But knowing them intellectually doesn't always stop us falling into them, and there's a reason for that. Knowing the rules doesn't automatically mean you'll follow them when the moment comes. I've seen that enough times to stop being surprised by it. The way our minds work, we're wired to respond to immediate needs more strongly than future costs. A redundancy check arrives in April, and you're focused on the relief, not on whether splitting it across the tax year would save you £3,000. Your state pension starts, and you start drawing from your workplace pension the same month, because that's what retirement looks like in your head. Someone tells you to take your 25% tax-free cash while you can, so you do. None of these are failures of intelligence. They're failures of context, and most of the standard advice doesn't provide enough of it. I'm not a financial advisor, and I don't know the specifics of your situation, but I've watched these patterns repeat often enough to recognize them. The most common mistake is treating retirement income as one large pool of money rather than as a series of individual tax years. Each year, you have a personal allowance, a basic rate band, and a higher rate band. Your goal, across every retirement year, is to fill those bands as efficiently as possible. Not to take everything at once, not to delay everything indefinitely, just to ask, in each year, what is the most tax-efficient amount to take from each source? That question, asked consistently, is what makes the difference. So let's pull the 6 traps together. Trap 1 is the 60% tax rate. Your personal allowance is tapered away on income between £100,000 and £125,140. You don't need a 6-figure salary to hit it. A redundancy, a property sale, or a one-off inheritance can do it. The fix is income smoothing, spreading large one-off payments across 2 tax years wherever possible. Trap 2 is the state pension shock. The full new state pension for 2026-27 is approximately £12,548, almost exactly equal to the personal allowance. Once it starts, your private pension withdrawals are taxed from nearly the first pound. The strategy is to use the gap before your state pension begins, when your allowance is fully available. Trap 3 is the emergency tax code. Your first flexible withdrawal may be taxed as though it's a monthly salary. Use Form P53Z to reclaim and ask your provider to request your correct tax code before you withdraw. Trap 4 is the tax-free lump sum taken all at once. Consider using phased UFPLS withdrawals instead. 25% of each withdrawal is tax-free, and the rest stays invested. Trap 5 is the GIA tax drag. Dividends above £500 are taxed annually, and the capital gains allowance is only £3,000. Use your annual ISARE allowance and bed and ISARE transfers to move investments into a protected environment over time. Trap 6 is the MPAA. Any flexible taxable income from your pension permanently reduces your annual contribution limit from £60,000 to £10,000. Use your tax-free cash first if you think you might contribute again. If you want more strategies for keeping more of your income in retirement, subscribe and turn on notifications. I release new videos every week. You've spent decades building what you have. A little planning at this stage can protect a meaningful amount of it. Thanks for watching.